Welcome to Axial Capital Partners, and to this video where we will illustrate the development finance package we were asked to structure by a developer with limited equity to build 12 new flats in Sussex. The video will cover 4 main areas, including an overview of the property itself. We'll look at the headline numbers involved in developing the project. We'll also look at the key margins and metrics that any developer should consider with an equity-based profit share arrangement. And finally, the return that a developer can expect to achieve when looking at a blended equity profit share finance package. So firstly, looking at the scheme itself, it's 12 flats to be built over 4 levels. See from the elevations here, it's a nice scheme overall. We look at the interior, at the floor plans. So 4 flats on the ground and first floor. The overall scheme was a mix of 1 and 2 bedroom flats. When we get to the second level, we can see there's one larger flat there, a 2-bed, and the top level we had a penthouse. So it's a nice scheme that will sell well down in Sussex. The reason you're watching this video, of course, is to get a clearer picture on how a blended equity and debt finance structure can work for a project like this. In this case, we look at where the end value is, and it was appraised at selling at £400 per square foot, giving 3.5 million of GDV. There are associated selling costs, of course, leaving a gross development profit of £3.4 million. Now that's come from our appraisal that we had put together by estate agents and surveyors. So the important factor now is, what are the development costs? The site acquisition in this case was agreed at £950,000. There was a CIL attached to this one of £113,000, stamp duty, ancillary costs. We come out at an overall acquisition cost of £1.1 million. We then have to consider the construction cost. Now this comes from the developer telling us from their experience what they can build at. Now the GEA, the gross external area, the build footprint of this particular project was just over 10,000 square foot. The developer knows he can build at just under £120 per square foot, giving direct construction costs of just under £1.2 million. Associated costs there, groundworks, etc. We come out at overall construction costs of just under 1.46 million on top of the 1.1 million land acquisition costs. That gives us total direct project costs of just over £2.5 million. Now, importantly, that gives us a 34% profit on cost, a gross uplift of 34%, which is a fairly healthy uplift on any sort of new development project. In this case, we'll apply a development finance interest rate of 6.65%, which is a fair midpoint. It can be as low as 5%, as high as 7.5%, depending on the quality of the project. 1% arrangement, 1% exit, again, fairly typical costs. Now we base this over 14 months of construction and sale period. That gives us an expected £133,000 of finance costs. This is based on tranche drawdowns through the cycle of the development. So with our direct costs and our finance costs, our overall project costs, £2.7 million with a net profit of £745,000 expected. So where does the money come from? How do we put the package together? We bring in senior debt. We look to work on a healthy 75% loan to cost. That way we can keep the core interest costs at that lower 5 to 7% range. We then go to one of our private equity lines. We brought in this case, not the total 770,000 you can see there, because the equity investor required the developer to also put in 90,000 of their own money. So the question then becomes, what does that give you as a developer? In this case, a return on equity of 414%, a profit share there of £372,000 is what this particular developer expected from this project. For money at that level, £90,000, that's a very solid return. When we put these packages together, we look at a couple of other metrics. This is where we can ensure that both our equity and our debt partners will be happy with the overall returns that the project is expected to give. So a brief summary of how that overall package looks. Project costs, direct project costs here, £2.5 million. This developer opted for a blended equity and debt model where we agreed a profit share. That allowed the developer to put only £90,000 of cash towards a £2.5 million development, which equates to about 3.51% of total costs was all they were required to contribute. This gave the developer a profit of £370,000 or a 414% return on equity. To see how we can do something similar for your next project, get in touch with us at Axial Capital Partners and we'll be glad to see how we can help out. Thanks for watching.